Welcome, listeners, to TalkTickers.
Your essential summary for earnings goals.
That's right. Today we're diving into Trustmark Corporation's second quarter results. We're going beyond the numbers to see how this bank might be, well, quietly setting itself apart.
Yeah, it's a really good look at how they're navigating things right now. We'll unpack the key financials, what management's saying, and their outlook.
Yep.
Get you right to the core of it.
Okay, let's jump straight in. The results snapshot. What are the key numbers, the highlights?
Well, first off, net income came in strong at $55.8 million.
Okay.
That translates to diluted EPS of 92 cents per share.
And that's up, what, 4.5% from the last quarter?
Exactly. A solid increase. Shows things are moving in the right direction profit-wise.
And how about those efficiency metrics like ROAA and ROATE?
Are pretty impressive there, too. ROAA, that's return on average assets, was 1.21%. And ROATE, return on average tangible equity, hit 13.13%.
13% ROATE, that's definitely strong. Shows they're using shareholder money well, doesn't it?
It really does. Very efficient capital use.
All right, let's talk growth. Loans are obviously key for a bank. How did they do?
Loans held for investment saw good growth, up 1.7% just in the quarter.
That's about $223 million.
Yep. And year to date, it's up 2.9%, so almost $375 million.
And where's that growth coming from? Is it all concentrated?
No, that's the interesting part. It's pretty diversified, led by mortgages, 1 to 4 family ones, but also other loans and leases and C&I commercial and industrial loans.
Okay, diversified growth is definitely a healthy sign. What about the other side of the balance sheet? Deposits.
Deposits saw some growth too, up $35 million over the quarter. And interestingly, non-interest-bearing deposits increased.
Yeah, that's good for funding costs.
It is. Though it was partly offset by a dip in interest-bearing ones.
Right.
But overall, personal and commercial deposits hit $13 billion.
Up almost 1% in the quarter.
Right. And crucially, the cost of their total deposits actually went down slightly.
Down in this environment.
Yeah, down 3 basis points from Q1, sitting at 1.8%.
Wow. Okay, so lower deposit cost, growing loans. That must have helped their net interest income, right? Their NII and NEM.
Absolutely. That lower cost was a definite tailwind. NII expanded 4.3% to $161.4 million.
Nice jump.
And that pushed their net interest margin, the NM, up 6 basis points to 3.81%.
3.81 NIM. That's a healthy margin, earning more on assets than they're paying out.
Precisely. And non-interest income, that held steady. $39.9 million, basically flat if you ignore some facility sales stuff.
Okay, let's talk expenses. That's always a big focus. How did they manage costs?
They seem really disciplined here. Non-interest expense did tick up a tiny bit, like $1.1 million or 0.9% in the quarter.
Which sounds like nothing.
Right, especially because it comes after a full year decline in 2024 and another drop in Q1 this year.
So the overall trend is still very much downward, or at least very controlled.
Exactly. They even saw salaries, benefits, and equipment costs go down this quarter, though professional fees went up a bit.
That kind of expense control in this inflationary period, that feels like a real strategic advantage.
I think it is. It points to operational efficiency.
In credit quality. Any worries there?
Actually, the opposite. It remained solid and even showed improvement. Non-performing assets, NPAs, fell by $5 million. That's over 5% down from Q1.
Good to see. Charge-offs?
Net charge-offs were pretty low, $4.1 million, or just 12 basis points of average loans. And that includes $2.7 million for 3 specific credits they'd already reserved for. So proactive.
Okay. And their cushion against future losses, the allowance.
Allowance for credit losses, the ACL, is at 1.25% of loans held for investment. Solid reserve level. The net provision for the quarter was $4.7 million.
All right. Sounds like credit is well under control. What about capital? You need a strong base for all this?
Definitely looking robust there. All their capital ratios went up. CET1, the common equity tier 1 ratio, up 7 basis points to 11.7%.
Strong buffer.
Yep. And total risk-based capital increased 5 basis points to 14.15%.
And are they returning any of this capital to shareholders, buybacks, dividends?
Both. They bought back $11 million of their stock in Q2.
Bringing the year-to-date total to
$26 million. And here's the kicker. They still have $74 million left on their repurchase authorization.
Wow. Okay. So plenty of dry powder there if they want to use it.
Exactly. And all this strength flowed through to tangible book value per share. It hit $28.74 at the end of June.
Which is up.
Up 3.5% from March and almost 14%, 13.9% to be exact, year over year.
That's significant value creation and dividends.
Steady as she goes. They declared the quarterly cash dividend, $0.24 per share.
Okay, so a really solid quarter across the board, it seems. Strong profits, good growth, controlled costs, improving credit, robust capital.
Pretty much ticks all the boxes for a strong regional bank performance.
Right. So we've got the snapshot. Now let's really dig in. What did management say about the future? Let's start with their forward guidance for 2025.
Yeah, this is where it gets interesting. Generally, they made positive revisions and affirmations pretty much across the board for the full year. Management did say, they're watching things like tariffs, policy changes, rates, credit, the usual suspects.
Standard cautionary language.
Right. But they haven't seen any significant negative impact on their customers yet, which sounds, well, pretty confident given the environment.
That confidence seems reflected in the loan growth guidance, right? They bumped that up.
They did. Revised it upward to mid-single digits for loans held for investment.
Which was previously low single digits.
Exactly. So that's a noticeable jump in optimism about loan demand or their ability to capture it.
Okay. What about deposits?
That was affirmed. Low single-digit growth expected for the year, excluding broker deposits. And they expect the securities portfolio to stay pretty stable, just reinvesting cash flows.
And the NM, the net interest margin, you said it was 3.81% in Q2. What's the outlook?
They actually tightened the anticipated range for the full year, now expecting 3.77% to 3.83%.
Tighter range usually means more confidence in hitting it.
Generally, yes. It was 3.75% to 3.85% before. So slightly narrower and maybe centered a touch higher.
And that flows through to net interest income, NII.
It does. They revised NII expectations upward too, now expecting high single-digit growth for the full year.
Up from mid to high single digits previously, more core earnings power.
That's the implication.
Yeah.
And on the credit side, another positive revision. The provision for credit losses is now expected to keep trending lower compared to last year, 2024.
Lower, not just stable.
Right. Previously, they guided to stability versus 2024. Now they expect it to trend lower. That's a definite plus.
And non-interest income and expense guidance.
No change there. Still expecting consistency on those fronts for the rest of the year.
Okay, this guidance sounds, well, almost surprisingly upbeat. When analysts dug into that revised loan growth, what were the specific drivers management pointed to?
It was a mix of things. They mentioned strong production in the non-CRE category, so non-commercial real estate going back to Q4 last year and through the first half of this year. Plus, they said CRE production itself was solid.
But wasn't there something about payoffs being delayed?
Yes, that was a key, maybe slightly surprising element. They noted significant delays in scheduled CRE payoffs. Over half of what was supposed to mature got pushed out, extended into the second half of this year, or even 2026, 2027.
So less runoff than expected.
Exactly. But management really emphasized that the encouraging part was the underlying growth in the non-CRE areas. Shows resilience.
Right. You don't want to rely just on delayed payoffs. Okay. On profitability, you mentioned ROA earlier. How sustainable do they think these efficiency gains are? What about those Fit to Grow initiatives?
Management seems to think there's more upside. They pointed to continued operating leverage, just basic balance sheet growth, and maybe even a bit more NIM expansion. They specifically said ROTCE will depend on how they manage capital, especially since capital keeps building up.
So efficiency is baked in, and future returns depend on smart capital deployment. Makes sense.
And that expense discipline we talked about, they really hammered that point home. They highlighted the actual expense decline in 2024 and the strong first half 2025, linking it directly back to those Fit to Grow and restructuring efforts. Their phrasing was basically that this discipline is paying dividends. It's fundamental, not just a one-off.
Got it. Now, the big one, interest rates, the Fed. How are they positioned? What are their assumptions?
Okay, so their base case assumes the Fed cuts rates in September and December. Pretty much aligns with market thinking right now.
And how does that affect them? Asset sensitive? Liability sensitive?
They describe themselves as slightly asset sensitive.
Meaning
if the Fed doesn't cut, they actually get a bit of a tailwind as their fixed rate loans and securities reprice higher over time.
Okay. And if the Fed does cut as they expect,
then they plan to be pretty proactive in adjusting their deposit rates downwards to protect that net interest margin.
So they feel prepared either way.
That was the message. They seem flexible enough to handle either scenario.
All right. Shifting gears to growth strategy. How are they balancing growing organically versus potentially buying another bank M&A?
They're pushing hard on both fronts, it sounds like. Organically, they're actively hiring bankers, bringing in talent in key growth markets.
Which markets?
Places like Houston, Birmingham, Atlanta, South Alabama, the Florida Panhandle, and also their home base in Jackson, Mississippi. Talent acquisition is key for organic growth.
And M&A merger activity.
Management confirmed what we're hearing elsewhere. M&A chatter and activity across the industry is picking up significantly. And Trustmark sounds very interested in participating.
Interested how? Aggressively, cautiously.
They framed it as strong interest, but coupled with a conservative, disciplined approach. Focus is clearly on deals that make sense for shareholders.
Did they give any clues about what makes sense? Their M&A criteria, target size, geography?
They did get pretty specific, actually. Gave us a good look at their playbook. Geographically, the focus is on markets close to where they already are in the Southeast. Mississippi, Alabama, Florida Panhandle, near their Atlanta office, Western Tennessee, Houston. They also specifically mentioned Louisiana, Arkansas, particularly northern Arkansas, more of Tennessee, Georgia, and northern Florida as attractive, fast-growing areas they'd look at.
So sticking to their knitting geographically mostly, what about size? Are they looking for big deals, small deals?
Generally, they're targeting banks in the $1 billion to $5 billion asset range as a way to sort of re-enter the M&A game. But they stress they'd remain opportunistic. If another deal, maybe different size, creates value, they'll look at it.
And they feel opportunities are increasing in those ranges.
Yeah, they explicitly said the amount of discussion and potential opportunities, both in terms of geography and size, is definitely on the rise.
Okay, good insight into their expansion plans. Let's circle back to credit quality. You mentioned the provision is expected to trend lower. What does that mean for reserves and the overall health of the loan book? Any surprises in the details?
Well, the provision outlook itself is good. Expected to be similar to the first half of 2025. One factor helping that is a big drop in unfunded commitments, down $187 million this year. Less potential future drawdowns means less need to reserve against them. It's de-risking.
Makes sense.
But here's the really surprising and positive detail. They saw meaningful reductions in criticized loans, those showing some weakness, down $71 million. And classified loans, more serious weakness, down $40 million.
Okay, reductions are good.
But wait, there's more. They actually upgraded $75 million worth of non-pass credits back to pass status.
Upgraded, so problem loans that got better.
Exactly. They successfully rehabilitated these credits, which means they keep the earning asset instead of just charging it off. That's huge.
Especially compared to last year, right? When rates were going up and criticized loans were generally increasing for banks.
Precisely. It really contrasts with the trend in 2024 and even the flat trends in Q1. This quarter's reduction and, more importantly, those upgrades signal very strong credit management and resolution.
That is a standout point. Okay, just a couple more details. Effective tax rate. Any change to the outlook?
Nope. Pretty straightforward there. They expect the full year 2025 effective tax rate to land somewhere between 18.3% and 18.5%. Year to date, it's 18.4%, so basically holding steady based on their income forecast.
Got it. And finally, non-interest income. What's driving the steady performance there? Anything specific?
Management basically said all of the above. It's a diversified mix. Wealth management is doing well, helped by market performance and more assets under management. Their brokerage business is also significant and benefiting from better markets. And they're seeing continued improvement in mortgage banking activity, even if it's not back to, historical boom levels.
So broad-based contribution. Good to see.
Yeah, it reduces reliance on any one thing. So, if you pull all this together, what Trustmark's report really signals is a bank with very strong fundamentals under the hood. And they've got a clear, proactive strategy. It's not just about riding out the cycle.
Yeah, those upward revisions on loan growth, the improving credit outlook, especially those upgrades you mentioned, it suggests they're managing risk really effectively and finding growth.
Right, in what's still a pretty dynamic environment. They seem to be handling the challenges well and positioning themselves for what's next.
Which brings up a point for you, our listeners, to think about. You hear about Trustmark's strong capital, the ongoing buybacks, that's $74 million still authorized, and then you hear management explicitly talking up their M&A appetite, even giving target profiles. How does that proactive stance compare to other banks you follow?
Yeah, some peers might be more focused on just building capital or dealing with issues. Trustmark seems to have this flexibility, this choice. They can lean into organic growth, they can ramp up buybacks, or they can pull the trigger on M&A if the right deal comes along. It's a position of strength.
Definitely something to consider in the peer landscape. Okay, let's pivot. It's time for our This Is Not Financial Advice segment.
Ah, yes, the fun part, where we brainstorm something a little out there, but maybe, just maybe, plausible. For thought experiment purposes only, of course.
Exactly, purely hypothetical. So what's the outrageous but plausible trade idea for Trustmark today?
All right, here we go. So we've established Trustmark has robust capital. They've got that $74 million buyback authorization just sitting there. And management sounds genuinely keen on M&A, right?
Right, they were pretty explicit.
Okay, so here's the thought. What about a long position in Trustmark stock, maybe paired with buying some short-dated, slightly out-of-the-money call options?
Okay, long stock plus calls. What's the outrageous part?
The outrageous part is trying to time it. You're essentially betting on a specific catalyst happening relatively soon. That catalyst could be them suddenly accelerating the buyback way beyond the $10, $15 million a quarter pace they've been doing.
Whoa.
Or they announce one of those strategic M&A deals they talked about, something creative that catches the market a bit by surprise in a good way, leveraging that conservative but opportunistic approach they mentioned.
And the plausibility.
The plausibility comes from the fact that they basically told us they want to deploy capital this way. They have the capacity. The intent is there. It's really just the when and the exact mechanism that's uncertain.
Interesting. Betting on the timing of a telegraphed move definitely fits the bill. Remember, folks, purely hypothetical.
Absolutely. Not advice.
Okay, let's wrap this up. To recap, Trustmark put up a really solid second quarter. We saw expanding profitability, that impressive expense discipline, and a credit profile that's not just strong, but actively improving with those upgrades.
Yeah, and their forward guidance reinforced that momentum. Positive tweaks to loan growth and the credit outlook really underscore management's confidence. They seem agile, ready to capitalize on opportunities while managing their capital smartly.
So this deep dive was all about giving you that concise, comprehensive picture of Trustmark's latest results and outlook, getting behind the numbers.
We hope it gave you some useful context and maybe a few things to think about. And just one more reminder, this discussion was for informational purposes only. It is definitely not financial advice.
Please, always do your own research and analysis before making any investment decisions.
Couldn't agree more.
Thank you for tuning in to TalkTickers. We'll catch you next time.